Suppose a company generates 1 crore of revenue and 20 lakhs of profit. Looks great. Would you invest in it? Everyone will say yes. But what if I tell you that the same company goes bankrupt in just another 6 months? Sounds impossible, right? So today I will show you how a profitable company can still run out of money and collapse. Let's take a simple example. Meet Anuj Foods Private Limited. Its revenue is 1 crore, profit is 20 lakhs, and there are 100 plus customers with growth of 25%. Everything looks healthy, right? Looking at just profit, if you were an investor, you would probably think the business is doing really well. So now there is the hidden truth. Revenue is 1 crore, but the cash collected is only 10 lakhs. And the 90 lakh of money is yet to be received and has been recognized in receivables. Can salaries, rent, and loan EMIs be paid using profit? The company recognized its entire sales in its books, but the profit exists, but the cash does not. This is where many people get confused. So this is the dangerous difference. Profit and cash are not the same thing. Profit is calculated using the accounting rules, but cash is the real money in your bank account. A company can recognize profits today and receive cash months later, but your salaries, loan repayments, and other expenses cannot wait. So there is a common saying that revenue is vanity, profit is sanity, but the cash is reality. Why revenue is vanity? Because a company might have generated 100 lakhs of revenue, but if the customers have not paid yet, then that number could be misleading. Why profit is sanity? Because it represents the better picture than revenue. It shows the earning income after all the expenses. But it is based on the accounting concepts and estimates. And cash is reality because we have to pay all our expenses like salaries, rent, loan repayments, and other expenses from our cash only. That's why we always say the cash is reality. So to know how a profitable company can go bankrupt, we need to understand 3 financial statements. First one is profit and loss statement. Second one is balance sheet. And third one, the most important, is cash flow statement. So the first statement, profit and loss statement, would tell us if the business is earning profit or not. It records all the incomes and expenses. Balance sheet would tell us how much are the assets and how much are the liabilities. For example, how much is the cash, inventories, receivables, payables, etc. In our case, balance sheet would show that there are 90 lakh of receivables that needs to be paid by the debtors. And the third one, financial statement, is the cash flow statement. It shows the movements of cash, how much is the cash inflow and how much is the cash outflow. For example, in our case, the balance sheet would show 90 lakhs of receivables, but the cash is only 10 lakh, and this will reveal the real problem. So every finance professional, investor, lender would see all the 3 statements together and would not rely only on one statement. Let's recall the example again. Revenue was 100 lakhs. Expenses were 80 lakhs. But the profit came out to be 20 lakhs. P&L says everything is fine, but that's not enough. When we come to the balance sheet, Here we see that the cash is only 10 lakhs and the receivables are 90 lakhs. And here the real risk is revealed. So the cash received is only 10 lakh, but we need to pay out our salaries, our rents, loan repayments and other expenses. And we see that the net cash flow is in negative and it's negative 3 lakh rupees. So we saw that the profit was positive but the cash flow is negative, and that is a dangerous situation for any company. So here is the final takeaway. Revenue is not success. Profit is not cash, but cash is the survival. If you understand this concept, then you have already become better investor than most of the beginners. So in the coming videos, we will learn about the financial statements from basic to advanced level. So if you want to learn, then please subscribe my channel and stay tuned for the next videos.